Welcome to today's program, Hack My MBA for Lawyers, Financial Statement Red Flags. My name is Zach McGee. I'm a Senior Vice President, Business Affairs for Sony Pictures Entertainment. Prior to joining Sony Pictures, I was an in-house lawyer at NBC Universal, and before that, I was a lawyer at Davis Polk. I've been writing and speaking on legal education topics for the past 20 years, including having taught a course on legal ethics at Pepperdine Law School. As you might expect, I am speaking today solely on behalf of myself, and my views don't reflect those of my current or any former employers or institutions with which I've been affiliated. This is the second program in our Hack My MBA for Lawyers series, so I'd like to say a few words about the genesis and purpose of this unique series of CLE programs. Over 10 years ago now, I was an in-house lawyer who sought to move from a legal to a business role, and as a part of making that transition, I decided to get an MBA. My thinking at the time was that I wanted to learn some of the finance and management skills that my clients generally learned in business school or in their work lives that we lawyers didn't learn in law school. If you've ever seriously considered going to business school, you know that getting an MBA is a time-consuming and expensive proposition. 2 years of your life and about $170,000 in tuition if you get your MBA in an executive MBA program like I did, so it's certainly not for everyone. I was fortunate enough to have my tuition paid by my employer at the time, which made the decision to take the plunge a significantly easier one. If you will be paying your own way, I think you need to think carefully before proceeding, because some MBA graduates don't end up seeing the higher salaries they are expecting to justify the cost of the program. In addition, signing up for 2 years of classwork, homework, group projects, presentations, and yes, exams, is not something most lawyers would want to do after already having been through all of that on the long path to becoming a lawyer. Chances are, when you went to law school, it was at a time in your life when you had a lot more time and energy to devote to school than you do now, when your weekdays likely are devoted to work and your nights and weekends are devoted to your families. If you were to enroll in an MBA program at a top school, you will find that in each MBA class, there are typically a handful of lawyers like us among a class composed of finance, marketing, IT, former military, and science types, all of whom are looking to acquire management skills to take them to the next level in their chosen fields or to help them switch fields. Being in classes with people from different professional backgrounds is a nice benefit of the MBA program. In some ways, it was a welcome change from law school, where everyone there is interested in doing something in the legal field. As a lawyer in the MBA program, I realized pretty quickly that there are some elements of the MBA curriculum that are tremendously valuable for practicing lawyers, and we've done the work to cull those elements out and present them in a series of programs intended for lawyers who want to learn these skills without spending 2 years and $170,000 to get an MBA. Another key benefit of these programs is that business folks in general, and MBAs in particular, have their own language, sometimes called MBA speak, that can be difficult for non-MBAs to understand. The concepts themselves aren't difficult. Indeed, I can assure you from personal experience that law school was conceptually much more difficult than business school. But you need some familiarity with them in order to understand fully what your business clients are saying, how they think about legal and business issues, and to some extent, to be able to speak their language in order to represent them well as their lawyers. Increasing your fluency with the tools that business people often employ and the language they speak is one of the main purposes and primary benefits of this program and the other programs in the Hack My MBA for Lawyers series. This program, Hack My MBA for Lawyers, Financial Statement Red Flags, focuses on teaching financial statement analysis and specifically looking at how MBAs and finance folks will analyze the key financial statements, which are the balance sheet, the income statement, and the statement of cash flows. We'll spend some time walking through each of these statements so that you can learn how to read them and what critical information about a company they provide. In addition to understanding the key financial statements, we'll also cover what kinds of ratios and analysis MBAs and finance folks would perform using the data contained in the financial statements to get a sense of how a particular company is doing, both in the abstract and relative to its peers in the same industry. This analysis also will include a review for red flags, which are things that companies can do when they're creating financial statements that may be misleading in some way or wanting to sort of misdirect or potentially engage in fraud, frankly. Being able to spot red flags in financial statements is very useful for anyone to know, but particularly for practicing lawyers and not just for securities lawyers. If you have occasion in your life or in your law practice to come across financial statements, the ability to have some fluency with them, the ability to calculate some useful ratios, and the ability potentially to spot some red flags is very valuable. So that's generally our objective for today's program. So, without further preliminaries, let's talk about the agenda today and what we're going to do in more detail. The first thing is we're going to look a little bit at the big picture. Why would you do financial statement analysis? Why is this something that your clients and finance types are doing routinely? What is the purpose of it? Next, we're going to do an overview of the key financial statements. That's the balance sheet, the income statement, and the statement of cash flows. I'm going to show you what these things are, what they show, and how they relate to one another. Then, we're going to move into a brief overview of some key accounting principles. When you talk about doing analysis of financial statements and you talk about red flags, you need a basic foundation of some of the key accounting issues and principles, and I'm going to give you a little bit of that. Then we're going to go into the first part of the financial statements analysis, which is using common size and ratio analysis to compare companies, both with their peers in an industry and across different industries. It's very powerful to help you see how an individual company is doing relative to its industry or its peers. And then finally, we're going to talk about red flags, how to spot some financial statement red flags, and give you some examples of actual companies where things turned out poorly for the companies. And if smart people had noticed the red flags earlier, they potentially might have been able to catch them. I think you'll find the examples are really interesting and ones that you've heard of before. Let's start with the big picture. Why do MBAs and finance types engage in financial statement analysis, and why is it worth learning about for you as a practicing lawyer? I think it's fair to say that if we had titled this course Accounting 101 for Lawyers or something like that, we would have had a lot fewer takers. This is not an accounting course. Instead, we're focused on trying to deliver the information that you may actually need in working with clients in the real world. This is the key information relating to financial statements that I felt it was enormously helpful to have some depth and some background in before talking with our own clients about these issues. And maybe not looking at them with such a blank stare when they begin describing their problems to us. The other thing I would point out is that in the MBA program, you take a lot of courses in finance, including complex courses in financial modeling or valuation. I'm not going to get into the particulars of those, and even as to the accounting, I'm just going to give you the things that you actually need to know. Financial statement analysis is particularly important because you're trying to answer a very basic question. Is the company that I'm looking at doing well? Is it overvalued or is it undervalued based on its performance? The current share price obviously is indicating what the market thinks of its value, but are there things that you can learn by looking at the financial statements that will better inform you and allow you to make better judgments about its valuation and its performance? Looking at several years in a row, are the key ratios trending in a positive way or a negative way? Clearly anyone can look at a net income line, but there are other ratios and other measures that aren't immediately clear from the financial statements that we think you need to look at in order to make those kinds of judgments. Obviously, as an individual investor, you may be looking at a company to decide whether this is a company you'd like to own. Is this a company you want to invest in? We're not trying to create professional investors. We're not professional investors ourselves, but we think that being fluent in these concepts is going to be important. Really, what these questions get down to are looking backward at a financial statement, which is by its nature backward looking. What can you assume or what can you reasonably conclude is going to happen in the future with that company? Namely, is it going to grow? Now, financial statements aren't the only things that help you think about that. They provide a lot of information, but they are in a sense limited. You wouldn't just look at a company's financial statements and try to make a judgment overall about the company. There are different types of analyses that you would want to do and you would learn about in business school. One example you may have heard of is to take a look at a company's price to earnings or PE ratio or its price to book PB ratio to help you determine whether a company's stock is over or undervalued. We're not going to cover those specifically today, but I think it's important to just mention them. Another course you would have in the MBA program is an entire course on strategy. And in that course, you would learn how to do a SWOT analysis, which stands for strengths, weaknesses, opportunities, and threats facing the business. Obviously, a lot of those are going to be qualitative rather than quantitative, but they're very, very important. The other course that is often taught in business school and is fairly popular is a course in valuation. Again, we're not going to be doing an entire course on valuation. Valuation courses teach you how to apply various models to arrive at the actual value of a company, whether it's measuring their cash flows or looking at them compared to their competitors, and thinking about what multiple their value may have relative to their earnings. Looking at comparable companies and trying to draw comparisons or to draw distinctions, these things are very important, but this is not the topic of today's discussion. I want to make sure that we don't get to the end of this and create the impression that financial statement analysis alone is going to answer all of the key questions. My point in raising it is simply that I want to recognize that financial statement analysis is by no means the only or even the most important tool in analyzing a company. It is one important tool in addition to the strategic review, the SWOT analysis that I mentioned. Valuation is another one. With those caveats, how should we think about financial statement analysis? Well, looking at one set of financial statements in isolation is rarely going to be helpful. All companies are going to be presenting substantially the same information, and we'll talk about the different rules that apply to that. They're going to be providing substantially the same information, and the idea is not to look at a company in isolation. The idea is to look at a company relative to other companies in the same industry, and you're trying to make judgments or assessments. Is this company more or less profitable than its peers? Is it more or less efficient? Does it involve more or less risk? If so, why are those risks something that can be contained or that are likely to be contained? In a moment, I'm going to go through two particular ways of looking at one company and its financial statements and comparing it to its peers to try to see where it fits relative to those peers. And that turns out to be the most important part of the analysis. One is called common size analysis, and the other is called ratio analysis, which is really looking at not just one number in isolation, but as the name implies, the ratio of certain metrics that you can get directly from the financial statements and looking at them relative to other metrics that you can get. And often, companies are not providing these ratios, but they can be calculated very simply based on the information that the company does provide in the financial statements. The last piece is the red flag review, where we look at a financial statement and see where there may be red flags. And by red flag, I don't mean to suggest conduct that is per se illegal or fraudulent. I simply mean something that is out of the ordinary or unusual, or maybe not sustainable as a business practice, that would cause a reasonable person to ask further questions and look further at other places in the financial statements, or frankly, to ask questions of management to understand why numbers don't look the way one would reasonably expect them to. With that introduction, let's turn to an overview of the three key financial statements. The three financial statements are the balance sheet, the income statement, and the statement of cash flows. We need to start there before we dig further. All public companies are required by law to provide certain disclosures, and those disclosures come in the form of the key financial statements. They're also provided by private companies in certain circumstances, but they are not required to be provided by them. Private companies do prepare these financials, but they're often hard to get because they're not required to be filed with anyone unless the private company has public debt or in other circumstances. But certainly, in your practice or in your personal investing, you may be presented with private company financials, and so the same analysis and techniques I'm going to show you would apply to those as well. The accounting rules are the same in terms of what private companies choose to report, in terms of how it's reported. It doesn't matter whether it's public or a private company. In terms of very basic background, I think many people who are familiar with securities or are involved in financial transactions at all know that every public company has to provide these statements to the public, to the investing public on a quarterly basis. Those are what are called 10Q filings, and those are reviewed but not audited. Auditors are looking at those, but they're not audited. The annual reports, which are the 10K filings, those are audited. Each of the 10Qs and the 10Ks contain, among other things, the balance sheet, the income statement, and the statement of cash flows. These are readily accessible, so you can get them from the SEC's website and also from the company's website, usually under the Investor Relations section. Another place you can get them is at Google or Yahoo Finance sites. These platforms collect all this information from the public filings and present them in some ways in an easier to read form. But the information often that's on Google or Yahoo Finance doesn't include all of the exhibits, all of the footnotes, and that can be important. One of the things that companies can do, and that can be a red flag, is bury information in footnotes. So if you really are going to dig into a company's financials, you're going to want to go to the SEC website or the company's website and get the actual Qs or the Ks with all the exhibits. As our example today, we're going to use Costco. I'm sure many of you are familiar with Costco, and I'm a big fan myself. We're going to use Costco as our guinea pig in terms of giving you an overview of its most recent balance sheet, income statement, and cash flow statement to walk you through it. We're also going to compare Costco to Walmart, and you'll see some interesting things when we do that, because in some ways, they're similar wholesale retailers, but in many ways, they're different. So let's take a look at Costco's balance sheet, income statement, and statement of cash flows in the context of explaining how these statements work. Let's start with the balance sheet. That's the first one. What is a balance sheet? It's a snapshot of a company's investing and financing activities at a moment in time. Now, the balance sheet and financial statements in general, they're always look backwards. They're always reporting the results of operations for some period of time, usually a year, but then also quarterly. The financial markets always look forward, though, when you're looking at how you value a company, how the stock market's determining Costco's stock is currently worth about $500 a share. That's as much about expectations of future performance of the company as it is about the historical performance of Costco. So there's always a little bit of a disconnect between what's on the balance sheet in terms of the historical reports and what's often most important for valuation. Another thing is that balance sheets generally show a company's book value, which is sort of the value at which its assets and liabilities are on the books. But that may or may not be their current fair market value. So if in the case of Costco, it owns some of its warehouses or owns some of the real estate under its warehouses, those would generally be carried at cost at whatever Costco paid to acquire those assets. But of course, they may have risen in value, or they may have gone down in value. But in any case, that's why the balance sheet is really sort of stuck in the past. That said, it's still a very useful tool. Let's take a look at a couple things that we can see from the Costco balance sheet. First of all, this is for the period ending August of 2023. And that's what Costco's fiscal year is. It's not a calendar year, but a fiscal year. And companies have the flexibility to do that. And it reports a total assets of just under $65 billion. So what's interesting about that is I mentioned Costco's current share price is about $500 a share. Costco has about 450 million shares outstanding. You multiply those two numbers together and you get something called market capitalization. That's almost $225 billion. The market values Costco at $225 billion, but on its balance sheet, there's only $65 billion worth of assets. Why the disconnect? And it's because of three reasons that I'd mentioned just briefly, but let's unpack them in some detail. First, everything on the Costco balance sheet is carried generally at cost, so there may be some appreciation that's not reflected on the balance sheet. But the other thing that's different is that many valuable assets that Costco has and other companies have are not reported on the balance sheet at all, which is interesting. One of those assets is the brand. Costco is a valuable brand. As I think you know, Costco has a very high brand recognition and a very loyal customer base. Indeed, Costco makes a lot of money from its members who pay an annual fee to have access to Costco's stores. But there's no line item on the balance sheet where you would see the value of Costco's brand. Similarly, Costco's employees, as you may know, are very well trained. Costco also pays high wages, which is part of their strategy for making sure that they have good employees and relatively low levels of employee turnover. That's nowhere to be found on the balance sheet. Not so much relevant to Costco necessarily, but to other companies is research and development. If you're looking at a company like Pfizer, for example, or a biotechnology company or a pure play technology company, all of your R&D that you've created value in terms of trade secrets, that stuff does not appear in general on the balance sheet. Now, if one company has acquired another company, there may be opportunities to put some of that in goodwill or to put some of that in other categories, but in general, balance sheets leave out all of those very valuable assets. That's the first reason why there's generally a disconnect between the market valuation of a company and the valuation that appears on the balance sheet. The second reason, and to fully understand this one, you need to understand the key equation for a balance sheet, which is that total assets equals total liabilities plus shareholders' equity. This is what they call an accounting identity. It always has to be true. In the case of Costco, that $65 billion in total assets is and you'll see exactly equal to the $65 billion in total liabilities and shareholders' equity. In terms of understanding how this equation works or why it's intuitively sensible, there's a lot of ways to think about that. But one way to think about it is, in terms of the people that have a claim on Costco's assets, there are two groups of folks. There are the shareholders of Costco, and there are the debt holders of Costco. Collectively, those two claims have to equal the assets of Costco, right? So if there was no debt, let's say Costco had no debt of any kind, then its shareholders would be entitled to 100% of Costco's assets. They would have that claim for every dollar of debt that Costco has. It reduces dollar for dollar the shareholders' claim on the assets and creates a claim for the assets for debt holders. So that's, I think, the easiest way to understand why this accounting identity, total assets equals total liabilities plus shareholders' equity. So the second reason why the total value of the assets for Costco is $65 billion, but the market value is $225 billion, is the difference between book value, meaning what's on the balance sheet, and what the actual value might be. An interesting example is if you were to have bought a company and let's say you paid $5 million for it, but because of its brand equity, it's worth $10 million. You might actually see that difference in the brand value on the balance sheet under goodwill. But when you simply grow a company organically and it develops goodwill, it's then not carried on the balance sheet. Now that may seem like a fine point, but it ends up being very important for large companies. A company with a very strong brand, say Coca-Cola, is not going to reflect the value of its own goodwill on its balance sheet. The third reason for the important difference between the $65 billion in assets and the $225 billion market cap is that the market is building in expectations about future performance. So that rather large delta of $160 billion is because the market believes that a dollar of assets in the hands of Costco is going to generate a lot more than a dollar tomorrow. And that has a certain value based on the rate of appreciation. And that's why there is a significant difference. While balance sheets are backward-looking and describe historical performance, the stock market looks forward to what earnings a company is expected to generate in the future. The other thing to point out is that if you look at the statement of liabilities and stockholders' equity, you have total liabilities of $43 billion. So by definition, the balance of that, in this case $22 billion, has to be either retained earnings or shareholders' equity. The point I want to make there is that there's a very important risk-reward trade-off that's occurring here. The banks that are providing the debt, in this case loaning money to Costco, their return on that debt is lower, and by definition, it's going to be in the amount of interest on a loan. That's because in the event of a sale, for example, of Costco, they're getting paid first. So there's less risk associated with that loan, with the money that they've provided to Costco. Therefore, they demand a lower return. But in the event Costco goes bankrupt or is in financial trouble, the banks, they get paid first. So it's both in the case of a sale for positive value above and beyond what the debt is, the banks get a full 100%, and on the downside, they get paid first. In that case, they may or may not receive 100% of their principal, depending on how many assets are left, but that's your risk-reward trade-off there. Lower return, but protection, both on the upside and the downside. To put a finer point on it, even in the unlikely event of a liquidation of Costco, if the total liabilities are $43 billion and you liquidate the company for its book value of $65 billion, the first $43 billion is going to go to the banks to pay back the debt. The additional value that is in market cap, the shareholders are holding on to that value. So if that value goes from $225 billion up to $500 billion, the banks who hold Costco's debt don't get any more money in the event of a sale of the company. They still get the same $43 billion. The shareholders are enjoying that extra return, but they're also taking the risk on the other side, right? The reason I raise this point is to emphasize that the market cap difference from book value isn't simply based on backward-looking features such as not having goodwill or brand value on the balance sheet at all, or even for assets such as property, plant, and equipment that's carried at cost that may have appreciated in value. All of this is part of it, but the main reason there is such a large divide between market value and book value for a company like Costco is because there are things baked into the market cap that are really forward-looking assumptions about how the company is going to perform tomorrow and how it's going to turn $1 into hopefully substantially more than $1. Costco is considered by the market to be extremely valuable because it is expected to turn each dollar it has access to in terms of invested capital, borrowed capital, and retained earnings into much more than $1 in the future. So that's the balance sheet. Let's talk now about the income statement. This is the second of the key financial statements. What an income statement does is report the results of a company's operations for a specific period of time. Normally, that's a year or it's a quarter. Like the balance sheet, there's a key equation for the income statement, which is net income equals revenue minus expenses. Let's take a look at Costco's income statement, and this again is for that same period, so September 1st, 2021 to the end of August 2022, which is Costco's fiscal year. During that period, Costco had revenues of about $227 billion, against about $220 billion in expenses, in which, after taking into account some non-operating income and expense, produced just under $5.8 billion in net income. These amounts are reflected on the applicable lines of the income statement. Now, if you look at Costco's income statement on Google or Yahoo Finance, you can easily compare the current fiscal year to prior fiscal years. And when you do that, you'll see that Costco has been steadily growing its net income over the last 3 years, and it's been growing it because its revenues are growing. So if you look at the top line, what people call the top line, which is the total revenue number, those numbers are increasing each year. Now, Costco's costs are increasing too, but of course the revenues are increasing more than the costs, and that's why the net income is increasing year over year. How does the income statement relate to the balance sheet? Simply put, the income statement links the beginning balance sheet that a company has on day one of its fiscal year with the balance sheet that it has on the last day of its fiscal year through something called the retained earnings line of the balance sheet. So if you go back to your balance sheet here for Costco, you'll see that at the beginning of the period, so this would be on September 1st, 2021, the retained earnings was $11.6 billion. And then at the end of the 2022 fiscal year, on August 28, 2022, it was $15.6 billion. So you may ask, if Costco generated $5.8 billion of net income during the 2022 fiscal year, why is the retained earnings line only $4 billion higher instead of $5.8 billion higher? One of the reasons is that Costco paid a significant dividend of about $1.5 billion to shareholders during that period of time. Costco also used some of its net income to add to its property, plant, and equipment, and to purchase some short-term investments. But in general, let's say there had been no dividends and no other activity, you would expect to see a company that did $2 billion in net income in a particular year, its retained earnings would go from $4 billion to $6 billion. That's the linkage between the income statement and the balance sheet. So that's very important because one of the key things about these financial statements is understanding how they relate to each other, and that for an income statement is through the retained earnings line item of the balance sheet. The other thing you can tell pretty easily from an income statement is the net margin of the company. So in this case, again, looking back at Costco's income statement, net margin is net income divided by total revenue. And so for Costco, you have $5.8 billion in net income that we talked about before against $222 billion in total revenue. So that's 3%. So a very thin margin of only 3%, right? You do $222 billion in sales to make essentially $6 billion of profit. This is very typical of retailers in general, in that they do a very high volume that runs on a very thin margin. So Costco's 3% margin is indicative of the industry as a whole. Just by quick comparison, the net margin for Amazon during the same period of time was 19%. So that's why it's also very important, as we're going to get to a little later. You can't analyze a company in a vacuum. If you were to just look at Costco's financial statements and you calculated the net margin and you say 3%, well, that sounds like a terrible business, but you can't make that conclusion. Costco is a great business for a lot of reasons that we'll explore later. You'll also need to compare Costco, and we'll do this shortly, to others in the same industry, such as Walmart, which owns Sam's Club, BJ's, which is another membership club. We likely would not include Amazon in this comparison because of how Amazon's business has evolved. When Amazon first started, it was an online bookseller that later expanded into general merchandise and also added a membership component that in the beginning entitled the customer to free shipping. If that was all Amazon was, it would make sense to compare Costco and Walmart to Amazon. But as we all know, Amazon has continued to evolve both through organic growth and targeted acquisitions like the purchase of Audible into a behemoth that now includes a film studio, MGM, a digital platform that includes an SVOD service, Prime Video, among many, many other businesses. Amazon is also a colossus. It did $500 billion in revenue last year and has a market cap of over $1 trillion. So it wouldn't be considered a peer company for Costco at this stage. You might say the same thing about Walmart. It did $430 billion in revenue and has a market cap of about $400 billion, but it is closer to Costco than it is to Amazon, both in terms of overall size and the nature of its business. Walmart is still primarily a brick and mortar retailer that includes a membership club under the name of Sam's Club, even though it is pursuing e-commerce, which Costco is as well, although not as aggressively as Walmart. In any case, that's a few words on why we're comparing Costco to Walmart, but not to Amazon. And the points we covered just now are the key points that you need to know about the income statement. Let's do the third of the key financial statements, the statement of cash flows. A statement of cash flows reports how the company generated and used cash over a particular period of time, generally over a month, a quarter, or a fiscal year, from the three main types of activities. Every sort of activity that a company engages in can be put into three categories: operating activities, investing activities, and financing activities. So, what are operating activities? Operating activities are just doing the company's business. So in the case of Costco, that's selling goods to consumers. Investing is investing in things like new property, plant, and equipment, for example, buying a warehouse. Financing would be things like borrowing money or paying off debt, such as taking out a loan to finance the purchase of real estate, or as we saw, paying a dividend. Those sorts of activities would fall into the category of financing activities. Now, turning this around, a company can acquire cash or use cash in each of those three activities. Let's talk again about operating activities. Costco can make cash by selling goods to its customers, but it could also use cash in operating activities by buying inventory. For example, it's buying goods and services that it will sell. For investing, Costco could buy a warehouse, upgrade a warehouse, or sell a warehouse. If Costco sells a warehouse, that's going to generate cash within this area of investing activities. And finally, in terms of financing, Costco could take out loans to acquire cash, and it could pay out dividends to shareholders. In the case of paying a dividend, that's a use of cash going out the door. In the case of taking out a loan, that's an inflow of cash being generated by a financing activity. What the cash flow statement does is show all of those uses and sources of cash over a period of time and organizes them in a way that will then show how much cash Costco acquired, how it was used, and what the net inflow or outflow of cash was for that period. If you look at Costco for the August 2022 period, the net change in cash for Costco was a little over $1 billion. Costco ended that period with $1 billion less cash than it had at the start of the period. So Costco used more cash than it generated over this particular period. Perhaps this is going to seem very basic, but one might ask the question, why do we need three different types of financial statements? I understand why we need a balance sheet because that gives me a snapshot of where my assets are and where my liabilities are. And I understand why we need an income statement because that shows presumably the amount of money that we made and the amount of money that we spent and then shows you the profit. So why do we even need a separate document called the statement of cash flows? Shouldn't the income statement cover that? And I will admit to having had that same question originally. And the answer is simply that the income statement doesn't reflect where cash came from and where cash was used. For example, if a company borrowed $100 million and then used that cash to make sales, that is not necessarily going to show up on the income statement. A company could be very profitable selling goods and show a huge net income number, but you wouldn't know just from looking at the income statement where that cash came from. You need to have an additional statement of cash flows to show exactly where the cash came from and where cash was used. In terms of linking the cash flow statement to the other financial statements, there's this direct link between the cash flow statement and the balance sheet, and that's in this total cash column. So if you look back at the Costco balance sheet, you'll see that as of the end of August 2022, Costco had $10.2 billion in cash on its balance sheet. And as of September 1st, 2021, the start of that fiscal year, Costco had $11.2 billion in cash. That's exactly the $1 billion difference that we saw in the income statement. So there's a direct link between the net result of the cash flow statement and the beginning and ending balance sheet in the cash line item. Now, we mentioned before that there's about $5.8 billion of net income on the income statement, but we see a $1 billion decrease in cash. So earnings went up, but cash went down. The statement of cash flows is what you can use to understand how this happened. The way to parse through that is through some items that are expenses. One large example of this is depreciation. Companies have to take a charge for depreciation. They actually want to take a charge for depreciation because they get a tax benefit by reducing earnings, but the charge will reduce their net income. Now, that's not a cash out event, it's essentially an accounting charge. So you may have a $2 billion charge for depreciation, as Costco has here, but no cash actually went out the door. So there's a little bit of a disconnect between net income and cash. Essentially, you have to work backwards and add back in things that were not uses of cash in order to get to your net income. Depreciation is probably the most complicated example of reconciling expenses to the cash flow statement because it's a non-cash expense. The dividend Costco paid of $1.5 billion is a cash expense, and it is categorized under financing activities. Another straightforward expense is the nearly $4 billion Costco spent to add to its stock of property, plant, and equipment. Again, a cash expense, so cash going out the door. If the purchases involve financing, the proceeds of those loans also would appear in the cash flow statement. As inflows of cash under financing activities, but we don't see a lot of that activity here, so it looks like Costco used existing debt to the extent it financed any of the acquisitions of property, plant, and equipment. To summarize the linkage, there is a link between the cash flow statement, both to the balance sheet directly in the total cash line item and indirectly in the net income line item of the income statement. Switching gears now, I'm going to provide a quick overview of some key accounting principles. This brings us back to the point about not naming this program Accounting 101 for Lawyers. I only plan to give you the basics that you're going to need in order to understand what I'm going to cover next. To begin, when I've mentioned accounting rules, to what am I referring? And if we have all these accounting rules that companies need to follow, how is it that companies are still able to get into trouble? Well, as with any set of rules or laws, it is impossible to imagine every situation, and it is impossible to make a rule to cover every possible scenario. While there are detailed rules and guidelines that companies are supposed to follow, there are gray areas, and there are words in these guidelines like reasonable and appropriate. And when you use words like that, you're going to see people making different judgments about how their circumstances fit within the rules. This is where law and accounting are very similar, right? You've got a set of laws, but very smart people like you are paid to think about where there is ambiguity or ways to come up with creative approaches, within the bounds of the law, of course, to give your clients an opportunity to present their case in the light most favorable when negotiating with the other side in a transaction or making an argument to a judge in a litigation matter. With accounting rules, accountants, and financial statements, it's the same idea. Companies rely on their advisors to help them present their financial statements in a way that's most favorable to the market, just like presenting your case in a way that's most favorable to a counterparty in a transaction or to a judge. And it all just stems from the basic self-interest of management in putting their best face forward. So, what are these rules? Well, you've probably heard references to GAAP accounting, and GAAP is simply an acronym that stands for Generally Accepted Accounting Principles. GAAP is the set of accounting principles that are used in the United States. Internationally, there's a different set of standards known as IFRS, which is an acronym for International Financial Reporting Standards. Now, because companies are increasingly global in nature, there have been a lot of efforts to try to get these accounting standards to be reconciled. I don't think they've been completely successful in doing that, and what that means is that there are a number of important differences between GAAP and IFRS, such as that if you're looking at a company's financial statements, probably the first question you're going to need to ask is what set of rules apply here. It's much like when you're a lawyer reviewing a contract. One of your first questions may be, what law controls? Are we talking about California law or New York law? Because here, if you don't understand that, then you may be applying the wrong set of rules. For example, let's talk about the treatment of research and development under the international rules. If a company invests $1 billion in research and development with some limitations, it's allowed to put that amount on the balance sheet as an asset. Well, if you think about it, that's a very interesting rule. What if the R&D turns out to be absolutely nothing, right? Yet the company would have a $1 billion asset sitting on the balance sheet. Is that truthfully communicating to investors the value of that R&D? Not in that particular case. Now, by the same token, that R&D could generate a new patent that could be worth billions of dollars. For its part, GAAP doesn't allow R&D to be put onto the balance sheet for exactly this reason. It's simply too uncertain. You can see the rationale for both positions, and it's just important to recognize that GAAP and IFRS can have significant differences in what they require, just like California and New York law can differ on key points of contract law, for example. Apart from knowing which rules you're playing by, it's also important to understand the purpose of the rules. What are both GAAP and IFRS attempting to achieve? At its most basic level, it's how do we get truthful information about the company's performance to be accurately reflected using some kind of standards that every company has to follow. You can imagine if you didn't have these rules, companies could use any different number of ways to describe how they did last year. It's a little bit like asking someone, how was your day yesterday? Well, and they can pitch that in any way they want. They can talk about only the good parts, or they may have an incentive to only talk about the bad parts. If you have a set of rules that says, I need to understand these 5 or 6 key metrics, you're going to have a basis for understanding some set of events in the past, and they're not going to be able to misrepresent those events as easily. It's also a little bit like the difference between having a resume versus having a form someone needs to fill out. A resume provides substantial leeway to focus on things or to ignore other things. A form, on the other hand, like the accounting rules, require answers to certain key questions while adhering to certain conventions. It's not to say that the rules and the conventions can't be interpreted differently by companies depending on what they're trying to accomplish at the time, and that's where we get into some of the red flags. But in a sense, the accounting rules are like a requirement that companies fill out a form, think of a blank balance sheet or income statement that needs to be filled out, and adhere to certain standards when they are interpreting that form to fill in the line marked assets, for example. When we think about trying to accurately reflect what the company has done in the past year or quarter or month, what types of key questions are we asking? One set of questions has to do with when and how do you recognize on your books an asset or a liability. For example, if you enter a contract to buy an asset, does that go on your books as you have the value of the asset on your books, or does it not? It has to do with the timing of the recognition, which simply means does it go on the financial statement yet or not? When you sign the deal versus when you may pay if it's later, and perhaps significantly later, let's say it's an executory contract or not, the timing turns out to be very important. And the word that you will hear time and again is recognition, which is, when do you recognize this thing? And recognition simply means, does it get included or does it not get included? And it can make a significant difference. Recognition is not simply for assets and liabilities. It also deals with revenue and expenses, which makes sense because a company usually has an incentive to try to recognize or include revenue as early as possible. But let's say I sign a contract with a customer that doesn't get fully performed for 3 more years, and I'm not having a great year this year. I might want to be able to show that revenue now to make this year look less bad. The rules on revenue recognition, which are quite complex and vary widely by the type of product or service you are selling, will answer the question whether the revenue can go on the income statement when I make the deal, or does it not get included until I've actually delivered the goods or services. These are the rules that prevent companies from prematurely booking or including revenue. By the same token, there are rules that have to do with when you recognize expenses, and you can imagine a company being in one of 2 tax situations. In one situation, the company has a lot of earnings and they're looking for expenses that they can take to reduce the amount of taxable earnings. And so they may wish to recognize or include expenses earlier than those expenses are really being incurred. Let's say, for example, I sell an item to someone and it has a warranty. Well, maybe I want to say that you can't do this by the way, but maybe you say I sold them a warranty that's going to cost me 20% of the sale price eventually because I'm going to have to provide some service or replace a certain number of the items. Let me take that as an expense now. Well, the fact is, you're not actually providing that service now. You're providing it later. So you can't take that entire expense. Now, even though you might want to offset all of this income so you can reduce your taxes, there also might be reasons why your company might want to show higher revenue, in which case you want to take expenses later. Suppose you've incurred an expense and it really is an expense that you've incurred in the current period, but you would like not to have to account for it now because it's going to eat away all of your revenue. You're not going to show any profits. That's going to be a problem. So there are rules that determine when you can recognize revenue or expense, just like rules that govern when you can recognize an asset or a liability. At the risk of going too deep into this, there are a whole set of other rules about how you classify these items as particular types of assets or particular types of liabilities. That becomes important because the rules for how you can treat that particular type of asset are different. Among the asset classes, and this is my favorite part, we just talked about revenue versus expense, and there are these two levers you can pull in terms of managing earnings. Sometimes you want to show more revenue, sometimes you want to show more expense, and if your objective is to land on a particular level of earnings in a given period. The other thing you may want to do, particularly if you're a public company, is you want to show steady growth in earnings. And nearly every public company actually gives out guidance and they say, hey, our earnings per share in the next 3 quarters is going to be X, Y, and Z. And the market very predictably and brutally rewards or punishes companies that either make or exceed their numbers or they don't make their numbers. This is the whole issue of earnings management, and this is going to be one of the areas that drives a lot of the sort of red flags and where many companies get into trouble. If you look statistically, and this is one of my favorite statistics, at the distribution of companies that either really miss their number, just miss their number, just make their number, just barely exceed their number, and blow their number out of the world, those are the buckets of performance that are being plotted on a distribution. What you would expect to find is the normal distribution of companies, the classic bell curve type pattern where the results are essentially random. But what you see instead is that there are many, many more companies than statistically you would expect that either just make their number or just exceed the number as opposed to just miss the number. This is very persuasive statistical evidence that people are playing some games at the margin to be able to push themselves into just making that number or just beating that number as opposed to just falling short because they know that the market is going to punish them for just falling short. You have statistical proof that earnings management is happening, and we already saw the 2 main levers for managing earnings, manipulating when you recognize something as revenue and conversely when you recognize something as an expense. So these will be key things to keep in mind when we talk later about potential red flags and more seriously, potentially accounting fraud. Now, I'm sure those companies who fall into the suspect buckets would explain that their guidance was more conservative than it should have been, and that's why they're just barely exceeding it. Everyone can make his or her own judgment about that, but another statistic that you might look at is what is the total amount of volatility that you normally expect, especially in higher risk industries with respect to earnings. Well, you might expect volatility to be very high from year to year, but in fact you see those values are a little flatter than some of you might expect. Now, some of that is the result of perfectly legitimate management decisions, making about how and when to do business and how and when to make investments or to expend cash and so on. But the data is simply too flat versus what you would expect for everything to be explained by good management decisions. And yes, part of your job as managers is to try to manage the company as best you can to avoid volatility. So is that what we're talking about when we say earnings management? Sometimes you'll also hear the term income smoothing. Isn't that what good managers are supposed to be doing? It probably makes intuitive sense to you to think about it that way. You are trying to smooth off the edges. You want your highs not to be so high and your lows not to be so low. But I want to be very clear, what we're talking about here is something that is an absolute violation of the rules, not prudent management. If you recognize revenue that the rules don't allow you to recognize early to smooth out your earnings, that is a violation of the accounting rules, i.e. your financial statements are no longer prepared in accordance with GAAP or IFRS and potentially illegal. There is an essential difference between being a successful manager while playing by the rules and being a successful manager by pulling a card out from your sleeve and introducing it into the deck. You would think everyone would want to play by the rules, and yet there is overwhelming statistical evidence that earnings management is going on to some degree among companies in the public markets. And it persists despite the substantial penalties, civil and criminal, that managers face if they get caught breaking the accounting rules. So why does it happen? It's because of the incentives that managers have to hit the earnings and other targets they have set for themselves. And I don't mean just incentives for the company and its stock price, but sometimes even their own compensation can be geared to hitting these targets. It's just human nature to want to cheat when the stakes are so high and personal. Apart from the general incentives and high-level techniques that can be used to manage earnings, let's talk about 3 specific examples of games that can be played with a company's financial statements that already might be familiar to you. The first is the big bath. Some of you may have heard the phrase, "the company took a big bath." What does that really mean? Usually, what it means is that the company had some sort of M&A event or restructuring activity, and when the company does that, it sets aside a reserve for the cost of doing that restructuring. The theory is that the market is going to be relatively forgiving for the cost of doing the restructuring or the cost of doing the acquisition because it's something that ultimately is supposed to be accretive or incremental to the company in terms of its future earnings potential. The company is going to make more money eventually, even though it had to take a hit now to do the deal or to restructure or streamline its operations. Think about the case of streamlining a company's business and what you need to do to implement that program. You'd have to break leases because you're closing locations. You have to lay off employees, so you have to pay severance. Those are the sorts of things that go into a restructuring reserve, and it's completely legitimate to have a restructuring reserve. The question is, how much are you putting into that restructuring reserve? Let's assume you estimate the restructuring cost to be $1 billion, but instead you decide to put $2 billion into the restructuring reserve. How you might do this is in a year that you have very strong performance, and I won't say hide, but you place the money to the side in this $2 billion reserve. There's now an extra $1 billion sitting there, and what that means is that it's a little bit of a rainy day fund, right? So next year, when your earnings looks a little softer, you can release some of those reserves. The company says, oh, look at that. We expected the restructuring costs to total $2 billion, and there are only $1 billion. We'll just go ahead and release the reserve. Releasing a reserve puts that excess reserve back into the income stream where it will push up the earnings. And now your earnings look a little bit better. So you've reduced your earnings in the year of the restructuring because you've had a $2 billion reserve instead of the $1 billion reserve. And then in the year that you're having difficulty, you put it back in, and that's what creates the income smoothing I mentioned before. Another thing that can happen in a big bath scenario, either apart from or in concert with some kind of M&A event or restructuring, is what's sometimes called the bigger bath. The best way to describe this is that if a company has any other significant problems that are going to impact performance in future periods, you'll often see companies making a bunch of difficult decisions all at once in order to take one bigger bath than a series of smaller ones. In other words, don't deal with the problems in each period. Don't take 3 or 4 small baths because the market will punish you for each bath you take. The thinking is to take the big bath at once. Then you have this reserve that you can selectively release or hold on to in order to selectively manage your way out of the difficulties. Once again, and to be totally clear, when we're talking about these things, these are clear violations of the rules that will get your company into trouble. This is earnings manipulation, a violation of the accounting rules, likely accounting fraud, and probably also illegal. We're going to look at an example of a company that got in trouble for precisely this sort of conduct a bit later. Don't do it, and if you see something, say something. The consequences for these things on a company, on an individual, on a career, particularly as a lawyer, are severe. The second specific example I wanted to mention is commonly referred to as the cookie jar reserve. Think of when you do a restructuring. You have a reserve, and then you can put extra money into the reserve and then fritter it out slowly in order to manage your earnings. Now, if you think about it, every company needs to have reserves at practically every moment in time, not just when there is an M&A event or a restructuring. Every company faces risk that it's going to have to pay money tomorrow for things like bad debt. Some companies are not going to pay, but you don't know today exactly which ones or how much they can pay. Or, as I mentioned before, warranty costs, which may be significant and higher than expected. The company also knows, and if it's big enough, it's going to be sued a certain number of times, and it has a certain amount of risk arising from pending or anticipated litigation, against which it is wise to keep a reserve. As lawyers, you've probably even been asked by your clients to give estimates of potential losses so that the company can set up its reserves. It's very common and prudent practice, provided that it's done by the book. Now, if you have regular reserves, but you then increase them artificially just so that you can fritter them out in moments of lower earnings, then that is something that's referred to as a cookie jar reserve. That is improper and it violates the accounting rules. But like other devices used to manage earnings, it's not uncommon. The fact that these reserves are regularly adjusted up and down in response to a multitude of events makes it harder to see when those adjustments are being done for the purpose of managing earnings. All we can see are the data that show that companies tend to just make or just beat their earnings targets more than they statistically should. We can see that this is happening at the macro level, but proving that any individual company engaged in earnings management in a particular quarter by dipping into a cookie jar reserve is harder to prove. But that will be the subject of a civil and potentially criminal case in the event things go south for the company and litigation is brought. Once the facts are laid bare and analyzed by experts, the fraud can be pretty easily detected and proved. It's just harder to see from the outside before all of the discovery is taken. The third example of a common technique that can be used to manipulate financial statements is simply recognizing revenue earlier than the accounting rules would allow. We talked about recognizing revenue early before, but this technique is so common and has caused the downfall of so many companies over the years that it bears walking through an example. A common scenario you see is a company that ships goods to a customer, but the customer somehow has a right not just to a return, but essentially to an unlimited right of return or a very long right of return. Is it appropriate for the company to book that revenue at the time the goods are shipped in that scenario? Because of the unlimited right of return, the company doesn't really have the unconditional right to retain that revenue. It's misleading in a financial statement if you include 100% of the revenue that you've earned because you can reasonably expect that a certain percentage of that product is going to be returned. This essentially has the effect of inflating the revenue and the earnings in the current period, and that is a violation of GAAP, but you wouldn't necessarily be able to tell this from the financial statements. That's a recurring theme we're going to see here today. It makes sense to study the financial statements closely because there are red flags. There are things in the footnotes that you can find. For example, if you read that the company assumed 100% of their customers would keep their goods and not return them, that would be helpful and a potential red flag. But more commonly, that wouldn't even be included in a financial statement. So I don't want to suggest that simply by reviewing the financial statements, you can spot all of these things. This is what the auditors are supposed to do and find, right? And we all know many examples, like some very famous ones like Enron, where the auditors signed off on the company's financial statements just a few months, weeks, or even days before the company collapsed. In some cases, the auditors did a bad job or suffered from conflicts of interest, but other times, the company simply was better at hiding its manipulation than the auditors were at uncovering it. That's not to say that auditors aren't tasked with uncovering manipulation. Indeed, they are. And aggressive revenue recognition, also called stuffing the channel, is so well known that auditors are specifically looking for evidence of this form of manipulation. If a company is stuffing the channel by working out a deal with its best customer to ship some goods that are beyond what the customer needs right now, combined with an absolute right of return, auditors should be asking the hard questions of management and the customer designed to uncover that kind of relationship. Indeed, this form of manipulation is so common it's become something that auditors specifically know to look for, because in countless cases where there's been accounting fraud, these are the sorts of things that you've seen, and it's really the auditor's job to try to sniff those things out. While you and I sitting here are very likely not to be able to uncover channel stuffing just by looking at the financial statements, reviewing the financial statements is the most basic thing you have to do to understand a company's performance. It is also true that some of the red flags that we're going to talk about later could lead you down the path to ask further questions, just as they hopefully will have led the auditors to ask those same questions as well, and that's how fraud sometimes gets discovered. Everything starts with the financial statements and a basic understanding of the accounting rules, which is what we've just completed. So congratulations, you now know just enough about the accounting rules to be dangerous, and hopefully I didn't bore you to death as if you were stuck in Accounting 101 for lawyers. Let's turn now to actually doing financial statement analysis. MBAs use two main tools when they're analyzing financial statements. The first is common size analysis, and the second is ratio analysis. These tools are really powerful in that they allow you to compare companies of very different sizes with each other and/or to compare them to other companies in the same or different industries. Common size and ratio analysis can answer questions such as, how much inventory does this company hold relative to its peers? How profitable is this company relative to its peers? How solvent or insolvent is this company relative to its peers? These are some of the really important questions that you'd want to know the answers to as an investor or as someone who's otherwise interested in a company, and these are the sorts of tools you would use to provide those answers. Let's look first at common size analysis. As our example that we've set out in the materials, we are once again going to use Costco, and this time we're going to look at Walmart along with Costco. Now, both the concept and the execution here are really simple. When you do common size analysis, you're taking the specific values that appear on a financial statement, and the example we've used here is a balance sheet, but you can do common size analysis with any financial statement, so the income statement and the statement of cash flows, although it's most commonly done with a balance sheet. And you express those items not as an absolute value, but as a percentage of some other thing, and normally it's total assets. So in this case, and you'll see from the materials, we've taken Costco's and Walmart's balance sheets, and we've expressed each of those items as a percentage of the total assets of Costco and Walmart, respectively. If you look at the total assets number for Costco, and that's the $64.166 billion number, and for Walmart, it's $244.86 billion. But then each of those other items on the balance sheet is expressed as a percentage of that total assets number. So what becomes immediately apparent when you do this kind of analysis for something like Costco versus Walmart is that you can see this right away. Walmart is about 4 times the size of Costco as measured by total assets. That's the $245 billion for Walmart versus the $64 billion for Costco. Another thing is just looking at one line item, let's say inventory. If you look at the total inventory number, and if you were just looking at the number itself, you'd say, well, Costco has got $17 billion in inventory and Walmart has $56.5 billion, so a lot more inventory for Walmart. But if you look at it as a percentage of total assets, it's much more comparable in that Walmart has about 23% of its total assets in inventory, while Costco has 27%. So while Walmart holds a lot more inventory than Costco, that's really just because Walmart is 4 times bigger than Costco. In terms of holding more inventory as a percentage of assets, Costco holds more at 27% as opposed to Walmart's 23%. This is an easy way to show you why an otherwise misleading comparison becomes apples to apples when you compare it by total assets as part of your common size analysis. Now, the comparison that we've done here for simplicity is just 2 companies. Typically, what you would do is you would have 5 or 6 companies that you're comparing when doing common size analysis. If you were looking across the same industry, maybe that would include Sam's Club, BJ's, and Target in addition to Walmart. Maybe you'd loop in Amazon, or maybe you'd leave Amazon out because of how different its business is in many ways. Whatever you choose, you'd look at a line item like inventory and be able to see a range. Maybe every company is between 23 and 27%, but one of them has 50% inventory, right? You're looking for the outliers, and you're looking to see whether there's a reasonable explanation for why one of those companies would need to carry 50% of its assets in inventory. There may be a compelling reason for it, and none of these things is in itself a danger, the answer to your question. Instead, each data point is a clue that might lead you to dig deeper and ask questions. It might be completely reasonable to carry twice as much inventory as a percentage of your assets as your peer set, but probably not though, which is why it is likely would be worth asking more questions about it. For this reason, it might be difficult to see outliers if you're only comparing 2 companies instead of 5 or 6, and we're doing that here only for simplicity. In the real world, you'd want to do 5, 6, or even more to give you more confidence when you identify the range and any outliers. I'm also being realistic here. This is not your day job, right? You're not a finance person. The way I think about this is that it will give you the tools to prevent you from drawing the wrong conclusions that you might otherwise draw. It will stop you from looking at Costco's balance sheet and saying, wow, Walmart's got $56 billion in inventory versus only $17 billion for Costco, and drawing the wrong conclusion that Walmart holds a lot more inventory than Costco, when in fact the opposite is true. The key is to know to do the common size analysis so you're comparing apples to apples and not apples to submarines. In this case, and at least based on our 2-company comparison, you wouldn't draw a conclusion that there's a significant difference between the inventory held by Costco and the inventory held by Walmart. Now, there are costs associated with having a larger inventory that is going to mean certain things in absolute terms. More warehouse space, more people to stock, etc. But the point is, you're not going to go off on a tangent and say, well, you know, there's a big difference in terms of the level of inventory held by these 2 companies if you do the analysis the right way. You're not going to reach a conclusion from one data point now that you've learned about common size analysis. So, total inventory is one potentially interesting data point. As I will get to shortly, there are many other ratios that tell you how efficiently you're using your inventory. So, for example, you might have much more inventory than a peer company, which sounds bad because you're carrying it and that has costs. But if you're delivering that inventory to your customers 3 or 4 times faster than your competitors, then you're actually in a much stronger position. In fact, one might even ask the question whether you should be carrying more inventory if you're turning it that quickly to make sure you don't have out-of-stock issues. The point is that none of these individual data points, and certainly not any data point as an absolute value, is dispositive in its own right. Individual data points and individual ratios give you some information and often prompt you to ask further questions, and also to look for other ratios that are important, like we saw with the relationship between total inventory and inventory turnover. Let's look at another data point, the property, plant, and equipment line here, also called PP&E, to see how they compare on a common size basis. Once again, there is virtually no difference in terms of percentages with both Costco and Walmart at 38 to 39%, even though the absolute numbers are very different due to Walmart's much larger size. Based on the similar percentages, you can conclude that Costco and Walmart are roughly equally exposed to changes in the value of real property, for example. If real property prices go up, that would benefit both companies to the extent they own the land where they have their stores and distribution centers. If the situation were different, let's say Walmart had 70% of its assets in PP&E versus only 38% for Costco, you could conclude that Walmart is much more exposed to fluctuations in the value of real property than Costco. That's the idea. Another example is the debt. So if you look at the total current debt of both companies in terms of the total current liabilities number, there is a significant difference in terms of 50% for Costco and only 36% for Walmart. A current liability is one that is due within 1 year versus long-term liabilities, which are due more than 1 year in the future. You might conclude from this that Costco is in some sense at greater risk because it carries more current liabilities than does Walmart. But you have to be careful because the flip side of current liabilities is current assets. Current assets are things that can be converted to cash within 1 year versus other assets and investments that would require more than 1 year to be liquidated into cash. Costco holds 51% of its assets in current assets versus 33% for Walmart. Do you see where I'm going with this? Costco has more short-term debt, but it holds more short-term assets, which makes sense. Costco keeps more cash and cash equivalents on hand in order to pay its current debts, so it balances out. Again, looking at only one line item, current liabilities, might have led you to draw the conclusion that Costco faces more short-term insolvency risk than Walmart, when in fact, Costco balances out that risk by holding more cash. It's more a preference to hold more current assets and more current debt for Costco than Walmart, rather than a signal of financial ill health or poor management. I promise, we will find some real differences between Costco and Walmart when we get to ratio analysis, so it's not at all about telling you that we really can't conclude anything. But I think you'll appreciate that a major purpose of this is to educate you enough about financial statements and common size analysis so that you don't fly off and draw conclusions that aren't warranted simply because you don't understand how to read and analyze financial statements. I can't turn you into a CPA, nor would you want to be one, but hopefully I can prevent you from looking foolish by failing to be measured and thoughtful in whatever conclusions you may offer. As Mark Twain famously said, "Better to remain quiet and be thought a fool than to open your mouth and remove all doubt." You are never going to be a financial statements expert based on 1 2-hour CLE program, but this program will help you develop a facility with financial statements and perhaps as importantly, to know what you don't know and how to ask the right questions. The next tool we're going to discuss is ratio analysis. So this is the same concept, except we're not going to be using one particular line item of each statement and then doing a simple calculation, turning that into a percentage, instead of an absolute number. We're going to start taking multiple line items and making ratios out of them. And that's what ratio analysis is all about. Now, there are literally thousands of ratios out there that MBAs and finance types have come up with, but they fall into 4 broad categories, and we're going to talk about a couple in each category. We provided a document for you that calculates those ratios once again for Costco and Walmart. So you can see both how they're calculated and how you can do some analysis based on them. The 4 categories of ratios are liquidity, profitability, efficiency, and solvency. And they are important because they can help you determine whether a company is healthy or not, is it doing well or poorly relative to its peers, etc. For example, how liquid are its assets and liabilities? How efficient is it? How profitable is it? How solvent is it? What is the risk that it's going to go to zero versus its peers? These are really useful and easy to calculate, so let's dive into them now. The first category is liquidity ratios, and these ratios measure a company's financial soundness and how well it can satisfy its short-term obligations. There are two very well-known key liquidity ratios, the current ratio and the quick ratio. The quick ratio is actually a slightly better measure of immediate liquidity because it excludes inventory. Now, looking at the two ratios as applied to Costco and Walmart, they actually both have pretty low current and quick ratios. And it's certainly hard in some sense to generalize, but many healthy firms have current ratios that are between 1.5 and 3, and a lot of people think a current ratio of at least 2 is preferable. In this case, the current ratios for both of these are just slightly over and just slightly below 1, with Costco at 1.02 and Walmart at 0.93. For the quick ratio, generally people think if that ratio is 1 or greater, a company is described as liquid, and if it's less than 1, it's described as illiquid. And in this case, both Walmart and Costco have quick ratios that are below 1, indeed significantly below 1, at 0.42 for Costco and 0.26 for Walmart. So what does this mean? It means that in general, there is some liquidity risk for both Costco and Walmart. Now, as a practical matter, both of these companies have a lot of cash on their balance sheet. They are high performers and they have pretty ready access to the capital markets. If at any time Costco or Walmart had a cash crunch, the overwhelming likelihood is they could go out into the market and borrow whatever funds they needed. So I wouldn't think of these companies, despite these low ratios, as having a lot of liquidity risk. But if you look at these ratios for other companies, you'll see very different things. You'll see some that are over 2, over 3, and those companies are considered to have little, if any, liquidity risk. Where you might worry about something like this in the case of a Costco or Walmart is, let's say that you have another financial crisis or another COVID crisis, events that economists like to call black swans. It's actually funny to say black swans because the whole idea is that these are the sort of events that come along once every 30 years, but we've seen 2 of these events in less than half that amount of time. But it's a situation where the world stops and all of a sudden the capital markets dry up, and then you could have a concern about the liquidity of a company that is otherwise as healthy as a Costco or a Walmart. So those are one of the things that you'd keep in mind when talking about a blue chip company like a Costco or Walmart. If you saw these ratios in a private company or even a public company that didn't issue highly rated corporate paper at will, you'd probably be right to be concerned about liquidity risk for a company like that. On the other hand, a company showing current ratios of more than 3 and quick ratios of more than 1 is probably not likely to succumb to liquidity risk unless and until the next black swan swims up and throws everyone's best laid plans in the garbage. The second category of ratios are profitability ratios. And these are the margins. You've likely already heard of gross and net margins, but there's also something called an operating margin. The one that most people haven't heard of is something called return on equity. These are all different measures of profitability. The margins just include or exclude different metrics from the profitability calculation so that certain expenses can be isolated. Return on equity is a little bit different in that it is a measure of how much return is generated on the equity that's been invested in the company. And what you see when you look at these numbers is that when you're talking about profitability, Walmart is somewhere between 3 and 2 times as profitable as Costco in terms of a gross margin and operating margin. But when you get down to the net margin, which includes everything, it's just net income against net sales, they're both roughly 3%, 3% net margin, which is typical for a retailer in a high volume, low margin business. When the return on equity numbers are looked at, you have 30% return on equity for Costco and only 15% return on equity for Walmart. So there's a significant difference between the gross margin, operating margin, net margin numbers, which favor Walmart or are equal, versus the return on equity number, which is twice as good for Costco versus Walmart. It's important to spend a little bit of time thinking a bit about the difference between, let's just use the net margin for simplicity against the return on equity number. So net margin is one of the most important indicators of a company's financial performance, and it's that percentage of revenue that remains after all operating expenses, interest, and taxes have been deducted from the company's total income. It's also fairly simple to understand. Let's say that you buy a box for $100 and you sell it for $125. the margin or the profit you made on that is $25, and this profit relative to the selling price is 20%. So 20% in that case would be your net margin. That's a pretty simple and intuitive concept to understand. Now let's think about that versus the return on equity. The return on equity ratio of a company measures the return rate which the owners of the company's common stock get in return for their shareholdings. So return on equity informs how efficient a company is in providing returns to the investments which it's received from those shareholders. So let's take another example. Suppose you just started a company with capital of $1,000. This $1,000 might be entirely yours, or you may have taken it from people in exchange for your company's shares. In any case, this $1,000 is invested in your company, and it's the total equity of your company. Next year, the business gives you a profit of $200, hence the return on equity will be 20%. So which of these is a better measure of profitability? Well, they're just different. So both return on equity and net margin are used to measure the company's progress, but they reflect different aspects of the business. So again, assume you have $1,000, you buy some goods worth $1,000. This $1,000 is your equity. Now you sell those goods for $1,400, which means you made a profit of $400. So again, your net margin would be that $400 divided by $1,400, and that's your, that is 28.6% net margin. On the other hand, the return on equity will be the $400 divided by the $1,000, or 40%. So importantly, it's really the return on equity that would decide if this company proposes a good potential investment opportunity. Return on equity shows the final return on that investment. Net margin only really explains what the company earns against the selling price that it charges. Now, is return on equity an absolute criterion? No. I mean, just like many other ratios and other data points that we've looked at today, a high return on equity is good with certain conditions. So you could have a company with 100% equity, or another company with 50% equity and 50% debt for its capital. Now, if they both had this, sort of same profit of, let's call it, to 20, let's say, again, keeping it simple, $100 of capital and $25 of profit. In the case of the company that had 100% equity, you've got that net profit of, the $25 against $100. So 25%, that's also your return on equity. But if you had a company that was, $100, but 50% of that was equity and 50% of that was debt, your return on equity would be actually closer to 40% because you've got to pay a little bit of interest on that debt, not, the 50% that you would expect. So here, the point is that with return on equity, it can be greatly affected by the mix that the company has of debt versus equity, whereas a net margin is really just an easy way to think about that is what's the profit that you're making off that good that you sell versus the selling price. So they're just really different metrics, but both are very important. Clearly, both companies are established and growing businesses with very large footprints and huge brand equity. Once again, you need to look at liquidity and profitability ratios to be able to assess the health of a company and also to compare it to its peers. But you can't lose sight of the big picture. Costco and Walmart are blue chip companies that aren't going anywhere anytime soon. It would be a huge mistake to think that either is a bad business because their liquidity ratios are lower than we'd like and their margins are in the low single digits. It's only when you recognize that all retailers operate on low margin, high volume businesses, and that any day of the week and twice on Sunday, Costco or Walmart could borrow as much money as they could ever need from the public markets at very attractive rates because of their balance sheets and decades of solid performance and growth. This is about preventing you from making mistakes that naive people, which includes most lawyers as it relates to corporate finance unless you practice in that area, might make. Remember the quick ratio. It's a good example where a ratio could be less than 1, and you could say, well, I read this book online and it says less than 1 is a problem. Then you have to just go and ask other questions. Which company are we talking about? How does it compare to other companies in the same industry? Is it public or private? Is it brand new or has it been in business for years? What is the trend line? Is it growing or shrinking? Based on your answers to these questions, the quick ratio may not cause you concern. Where it may cause you concern is where a particular company you're looking at is way out of whack with others in the industry. Retailers have low margins, and that's because that's part of the value proposition they're delivering to consumers, is to sell goods very close to their costs. They're driving down costs, and they're trying to pass substantially all of that on to their customers. A luxury retailer might have very high margins, and you would look at it compared to other luxury retailers, but you wouldn't compare Cartier to Costco, even though they both sell luxury watches. Another thing I love about doing this type of analysis is that these tools allow you to confirm your intuition or to disconfirm it. We've all been to Costco, most of us have been to Walmart, and what you see is a lot of traffic and very low prices. So they are doing a small margin over a large volume. The ratios confirm what your intuition already tells you about the businesses of Costco and Walmart. The next category of ratios are the efficiency ratios, which help us answer the question, how efficient are the company's operations? Two ratios we look at here are both turnover ratios. The first is accounts receivable, or AR turnover, and the second is inventory turnover. The AR ratio is how quickly is the company turning its AR into cash. Most companies have receivables from customers, and how quickly is the company collecting those? That's the AR turnover ratio. As for inventory, how quickly is the company turning its inventory into cash? As we will see, both Costco and Walmart are very efficient. Let's start with Walmart this time, and so Walmart's AR turnover ratio is nearly 58. Which means that Walmart is turning over its entire AR balance into cash almost 58 times in a one-year period. Costco's AR turnover ratio is even better. Costco turns its entire AR balance over into cash more than 110 times in a year. What about inventory? Walmart turns over its entire inventory balance into cash more than 8 times in a year, and Costco does the same thing more than 12 times in a year. Those are really good numbers that show just how efficient these two companies are. Interestingly, you can also flip these ratios over and calculate how many days it takes them to turn over the inventory. So take 365, the number of days in a year, and divide the ratio by that. When you do that calculation for Costco, you get 3.32. So on average, every 3 days, Costco is turning its receivables into cash. And every 30 days, technically every 29.4 days, it's turning its inventory into cash. Once again, this confirms your intuition when you set foot in a Costco. Merchandise is literally flying out the door. Shoppers are loading up their carts, sometimes more than one cart or even one of those giant flatbeds, and buying huge amounts of products each time they visit. Sometimes the lines to check out at Costco are really long because each shopper is buying so much in each trip. It really doesn't pay to go to Costco and deal with the lines just to buy a couple of items, so shoppers really load up when they shop there. On the AR side, shoppers are paying in cash or debit cards or credit cards, which Costco collects very quickly. It's not a situation where Costco is shipping goods and issuing invoices for customers to pay on time. It's paid in full at the time of sale. It's the same story with Walmart, just not as extreme. AR is nearly equally as quick, maybe slightly less cash or debit cards at Walmart, and Walmart does have a larger online channel where shoppers could use other payment options like PayPal or Venmo. That might delay receipts a bit versus Costco, where nearly all sales occur at the warehouse at the time goods are delivered. Shoppers don't tend to buy as much at Walmart as they do at Costco, and instead, they visit Walmart more frequently as opposed to the once every month or 2 months we see at Costco. These are some of the reasons that we see the differences between Costco and Walmart in terms of the efficiency ratios. But the thing to keep in mind, and we would see this if we looked at more companies in retail or at companies in other industries, that Costco and Walmart are each crazy efficient. That Costco's efficiency ratios are better than Walmart's doesn't mean that Costco is efficient and Walmart isn't. The truth is that Walmart is very efficient and Costco is stupidly efficient. Much of what this is educating you so that you don't leap to conclusions based on a single or even a couple data points or based on a comparison of just two companies. It's a good lesson to see differences in the numbers, but to understand the big picture. The last category of ratios are solvency ratios. These are the ratios that talk about leverage of the company. So how much debt does it have relative to its equity? And therefore, how much risk does the company have? Because if it has a lot of debt, you've got to service that debt. And then if anything happens in terms of a business downturn, then you have some risk. Here, higher numbers are bad in that they reflect more leverage and more risk. Not surprisingly, the numbers for Costco and Walmart are pretty low. Take the first ratio, which is financial leverage. Costco is just over 3, and Walmart is just over 2.5. Those are very good ratios. You'll see some companies above 10 or even above 20. And in those cases, you have companies that are highly leveraged and where you see a risk of insolvency. It's not surprising that we don't see that for Costco or Walmart. Debt to equity is the next ratio, and we have 2.11 for Costco and 1.66 for Walmart. Generally, a good debt to equity ratio is anything lower than 1. A good debt to equity ratio is generally below 2 for most companies and industries. Walmart meets that standard, while Costco slightly exceeds it. So while you could say that Costco is slightly riskier than Walmart based on the debt to equity ratio, you'd want to measure that conclusion by looking again at Costco's overall balance sheet. You'd also need to think about Costco in terms of the retail industry as a whole. Recall what we learned about retail. What we saw is that it's a low margin, high volume business with net margins around 3% and inventory turnover averaging around 10. Walmart was 8, Costco was 10. So a lot of stuff is going out the door all day, every day. You also realize it requires large investments in property, plant, and equipment. You have to have a lot of stores, you have to have a lot of real estate. We saw from the common size analysis we did that both Costco and Walmart have about 40% of their assets in property, plant, and equipment, and about 25% in inventory. Once again, the financial statements are confirming for you what you intuitively know. Another thing we touched on briefly when we were talking about efficiency ratios, but didn't fully connect the dots, is positive float. Positive float is where you're getting paid very quickly, your AR is turning over very quickly, and you're slow to pay your suppliers given their size and given the leverage that it gives them. They're able to collect cash from their consumers in 3 or 4 days, essentially, right? And then potentially not pay the people providing the goods for 30, 60, maybe in some cases 90 days or even longer. They're getting the benefit of that float. When your margins are as low as theirs are, there's everyday low prices at Walmart and Costco certainly competing on price as well. The value of holding onto that cash, even just for those 90 days, can be very important. We also should mention in this regard that both Costco and Walmart, via its Sam's Club warehouse brand, collect annual membership fees from customers. So they are collecting additional money each year at the start of the year, membership year, that they get to bank before their customers actually buy anything. The ratios show in general that Costco and Walmart are collecting money more quickly than they're paying it out. This tends to push up current assets, which is a high quality problem to have, and we see this for Walmart and Costco. So once again, whatever slight increase in financial risk you might be tempted to assign to Costco because it has a 2.11 debt to equity ratio would need to be tempered by what a great business Costco is in terms of collecting cash, enjoying the float on that cash, and turning AR and inventory so very quickly. Costco has the ability to dig itself out of any financial trouble it may find itself in because of the economics of its business, not to mention its status as a stable performer over 40 or so years. I want you to do the analysis and have some theories based on that analysis, but also to realize that you need to be measured in any conclusions you might be tempted to draw. It's very difficult to pick up one financial statement or set of financial statements for one company and make sense of it, much less to take a single data point or ratio in isolation and try to draw some conclusions from it. The most intuitive way this is explained to me is that it would be something like coming to you and saying the score of the football game that our team got 24 points and just ending it right there. That's a little bit like what you're doing when you read a financial statement. You're finding out this company had revenue of a certain amount, and just like our team had 24 points, means absolutely nothing. Because the question is, compared to what? If the other team had 21 points, well, 24 is a good number. But if the other team had 28, it's a bad number. And I'm not even thinking about the spread for betting purposes. The point of ratio analysis at its most basic level is to look at a company and say, here's what they did compared to what another company did, and then compare it to other values on the financial statements and an understanding of the company's overall business. Ratios and numbers standing alone are really not terribly helpful. It pays to look at numbers as they relate to other numbers, and not just one, not just two, but several of them. You also don't have to do all of this yourself. There are a number of resources available, Google Finance, Yahoo Finance, Motley Fool, to name just 3, where they will crunch all of these numbers for you and also provide some analysis. The key is to be able to look at them as a whole picture and compare it to other companies in the same industry. You're looking for favorable ratios of this company as opposed to other companies in the same industry. And then you're looking for an absence of red flags, which is our next topic. You want favorable ratios, but you also don't want to see things that would cause you to ask further questions. My hope is that this program will make a more educated and critical consumer of that data out of you, and that analysis that you were when you started this program. In the materials that accompany this program, there's a document entitled, A Few Potential Red Flags in the Financial Statement. The subtitle is Signs That One Should Ask Further Questions. Obviously, I'm a lawyer, so it won't surprise you that I've qualified how I describe the document more than once. First of all, when I say potential red flags, What I intend to convey is that you're never just looking at one metric and saying, aha, that's a clear red flag indicating fraud. That's not how this works. You shouldn't reach any conclusions based on a single red flag, but rather, a red flag is a sign that one should ask further questions. I'm really just repeating what I said earlier, which is that these are clues that you should be picking up on and using as a basis to dig further. In a way, the document is like an issue spotter that will help you to think about the different categories of problems divided up conceptually that can come up to help you know what to look for. The first category are problems that misrepresent a company's current financial condition. And on the left-hand side, you see things that companies may do in their financial statements that can overstate the value of their assets. On the right-hand side, you see things a company might do to understate its liabilities. By definition, if you're overstating the assets and you're understating the liabilities, you've created a situation where the apparent value of the company has been overstated. Under overstating the company's assets, there are a few common tricks that are used. One is showing assets at a valuation that isn't really fair. So for example, the company buys something, its book value is 10 million, but now the fair market value is only 1 million. If you look at the balance sheet and you see 10 million, that probably needs to be at some point marked to market or the value of the asset impaired. Otherwise, you're getting a misleading picture. Recall that we talked about how, in general, assets are on the balance sheet and carried at cost, but the accounting rules do require that if at some point the value is impaired, you have to take a write-down. So that allows some flexibility in delaying that write-down that would otherwise be necessary as a way to overstate your assets potentially. And it makes the value more conservative because if the value has increased, you're not necessarily allowed to mark it up. It's a one-way adjustment generally, so as to be more conservative. If it goes up, you're not marking it up, but if it's been impaired, you're going to mark it down. This is a good time to mention a recent example of a corporate implosion of which everyone is no doubt familiar, the collapse of Silicon Valley Bank, SVB, in February of 2023. SVB got into trouble because it had bought a lot of long-term U.S. Treasury bonds, the value of which fell drastically during the period when the Federal Reserve was raising interest rates from essentially 0 to nearly 5%. Because the massive reduction in value of these assets on SVB's balance sheet, SVB wasn't required to mark them to market, i.e. to write down their value to reflect the current market price, because of an accounting rule that allowed them to continue to carry those assets at cost because SVB intended to hold them to maturity. Now what happened was that depositors started pulling their money out of SVB and new money wasn't coming in as fast as it had in the past, which forced SVB to start selling those bonds at a loss to cover the withdrawals and thus to disclose the losses once they were realized. At that point, depositors got nervous and a run on the bank ensued, which led to SVB's rapid collapse. This is a great example of the difference between assets carried at cost versus fair value. It's also another good case study in terms of why it isn't easy to spot a company that is at risk of going bankrupt. As I mentioned, the accounting rules allowed SVB to do what it did, so they weren't breaking or even bending the rules, and thus there were no red flags in their financial statements to find per se. Now, smart folks who know that carrying assets at book value when those assets really are impaired is a potential red flag, and you can count yourselves now among that group, who then put this together with the effect on bond prices driven by rapidly rising interest rates, could have predicted that SVB and other regional banks were in trouble. But the point is that it's not obvious, but knowing some of the common danger areas can lead you to ask further questions that could uncover something before the rest of the world knows it. Another category is overvaluing inventory. If you buy a bunch of inventory, say you're a computer maker and you spend $10 million to buy a large number of computer chips, but then the next day a new chip comes out, maybe that $10 million worth of chips is only worth $5 million. If on your books it still shows $10 million, you're overstating the value of your assets. Another asset on the balance sheet are accounts receivable, and not surprisingly, this too can be manipulated. If you're selling exclusively to customers who aren't likely to pay, then you don't really have as much money coming in as you may be representing in the AR line. The value of your accounts receivable is overly optimistic, and instead, you need to make a reasonable judgment about how much of those receivables you're actually going to collect. I don't know many businesses that collect 100% of their receivables, so if the company is assuming that, that could be a potential red flag. Lastly, if you think about the property, plant, and equipment, if you assume that it's going to have a longer useful life than it really should, that also can have an impact. Useful life estimates need to be realistic, so that depreciation charges can accurately reflect the reduction in value of PP&E over time. Now let's go to the other side, understating your liabilities. One massive liability some companies have, although they are much rarer these days than in the past, are pension obligations. If you make assumptions about how the pensions are calculated or how many people are going to reach retirement age or what their likely life expectancies are going to be and how much you're going to pay, you can end up significantly understating that liability that the company bears. Warranty obligations are another one that we touched on briefly before. If you're making a product and you assume it's going to be 95% defect-free and 5% of them are going to have to be fixed, maybe that's overly optimistic. Maybe you should be making a different assumption that the company is going to have to replace or provide warranty coverage on a larger percentage. The next category is failing to reflect all loans on the balance sheet. And the problem here is that, of course, you won't see it on the balance sheet by definition. It's when a company does what they call off-balance sheet financing. The entire point of off-balance sheet financing is to keep it from showing up on the company's financials. And there are various special purpose vehicles that smart and, you might say, devious people have come up with to do that. Enron is the most famous example of a company that used various vehicles to keep loans off its balance sheet and that contributed to its ultimate downfall. For our purposes, it's just enough to know that if loans are being kept off the balance sheet, that's a potential red flag. There obviously have been efforts to crack down on that post-Enron because it does provide such a misleading picture to investors. Another category is where a company may have a long-term lease, which is effectively equivalent to a debt, but it's recorded as a lease and thus it lives off the balance sheet. For example, if you have to make a lease payment for, say, 40 years and you don't have any way to get out of the lease before the 40 years is up, you have obligations there that look a lot like debt, just as it would if you'd borrowed money to buy the building. Lease payments are a monthly expense but not carried as a liability on the balance sheet versus a debt that would be both monthly payments and carried as a liability. This is another source of potential shenanigans, and there are rules about when certain long-term leases need to be reflected as debt, so playing games with those is another danger area. The last category is understating contingent liabilities. Let's say, for example, that you buy a plant and it has some environmental problem, and there's a massive contingent liability there, but that liability isn't properly taken into account, so your liabilities are understated. Those are the top category, which all fall into the category of misrepresenting the company's financial condition and all relate to the balance sheet, which is a snapshot of the company's financial condition at a point in time. The second category relates to misrepresenting the company's financial performance, and so not surprisingly, we're moving to the income statement now because we're talking about a company's performance during a time period. As you will recall, the two main components of the income statement are the revenue and then the expenses, and the difference between those two represents the net income. Starting with the revenue side, we've already talked about the first example, which is prematurely booking revenue that's not yet earned. If I enter a deal to provide services for 3 years in exchange for $100, if I book all of that revenue, the full $100 right now, that's misleading because I haven't earned the right to collect the full $100 because I still have more services to provide in the future. Another example is the flip side of something I mentioned earlier, which is selling to customers who are unlikely to pay. If I go down the street and I collect IOUs from a bunch of school children to buy fancy computers, and then I go to my financials and I indicate that I've earned all this revenue, that's probably very misleading because I'm overstating the revenue by booking revenue based on sales to customers who likely lack the ability to pay. Channel stuffing is another example of prematurely booking revenue. To remind you, channel stuffing simply means that you get to the end of your fiscal year or fiscal quarter or month or whatever, and you haven't hit your number. So you call the customers and you say, I know you only need 10,000 a month or a quarter or a year or whatever, but what if I sold you 50,000 units right now so I can hit my number for the period? But what you're not disclosing is that for the first 3 or 4 or 5 months of the next year or quarter or month, they're not going to buy any more units because you've stuffed the distribution channel full. That's where the name comes from. And this is where the auditors tend to see a bunch of sales that happen on March 30th, June 30th, September 30th, and December 31st, i.e. the last day of the month or the quarter or the year. And that's a red flag that channel stuffing may be going on. These are the sorts of things that you're not going to see from the financial statements, but the auditors are, at least in theory, going to see it. The last category here is maintaining excessive reserves to smooth out income, which is another topic we covered earlier. A reserve is simply a pile of money that you keep on the side to use for some contingency. And if you put too much money to the side, you can use it to feed the income stream as needed in order to smooth your results. That reduces the appearance of volatility in your company revenues and can be used to deliver predictable earnings, which increases the value of the company to investors. Now, as you'll see from some of the examples where you've had massive fraud, even the auditors were deceived in cases where companies were later found to have stuffed the channel, or to have held excess reserves, etc. Sometimes the auditors were laboring under conflicts of interest because they earn other revenues from the company beyond the fees to audit financial statements, which are relatively modest as opposed to the fees these firms might earn from consulting work, advisory work, etc., that cause them not to look very hard or to question things as much as they should have. But even when the auditors are fully engaged and operating free of conflicts of interest, smart fraudsters can deceive them too. The point of this program in general, and this discussion of potential red flags in particular, is to alert you to some of the categories of things that could present potential red flags on the financial statements that would cause you to ask more questions and cause the auditors to ask more questions. And theoretically, the auditors are doing their jobs, they're asking those questions, and if they don't get satisfactory answers, they're not signing off on the financials as having been audited. That's how the accounting and audit rules are supposed to work, and probably do work in the vast majority of cases, day in and day out. It's the cases where it doesn't work, the Enrons, the Lehman Brothers, the Nortel networks, that are the oversized and outsized exceptions that prove how well the system works overall. I think you certainly can say that our system in the United States under GAAP and the system in Europe under IFRS works well, particularly when compared to China or to countries in the developing world. One's confidence level in the audited financial statements of companies in the US and Europe greatly exceeds whatever level of confidence, if any, he might be tempted to place in audited financial statements of Chinese companies or companies that operate in the Middle East or South America. Much like democracy, which is the worst form of government except for all the others, GAAP and IFRS are the worst forms of accounting rules and practices except for all the others. The last category of things that could be used to possibly misrepresent the company's financial performance involve understating expenses. The first item, which arose as a problem probably 10 or so years ago in the tech sector, had to do with options that companies would grant to employees, but the company would not include those options as an expense. Certainly, the salaries those employees were paid were carried as expenses, and we very clearly have expenses associated with generating that revenue. But options are also a form of compensation, and not all companies were including those as expenses. A related issue involved backdating options that already had been granted to reduce the magnitude of the expense to the company. Now, oddly, these companies that engaged in backdating options wouldn't have gotten in trouble if they had been accurately disclosed and reported. But the issue was that it wasn't accurately disclosed or reported. Giving an employee a backdated option that already had value means you should have booked that expense as opposed to booking no expense. In the typical case, options don't have value at the time they're granted because you are trying to incentivize the employee to help build value at the company, such that at some time in the future, the options granted will become valuable because the company becomes more valuable. That's what these companies were doing and failing accurately to disclose or report it on their income statements. I'm sure you heard of the options backdating scandals a few years back, and as with many of these examples, these are the sorts of things that often, when companies are in the news for bad behavior, it's these sorts of accounting red flags that are behind those headlines. Another category relates to capitalizing expenses rather than deducting them in a current year. What that really means is that you have an item that you've purchased and it really should be expensed this year. If you expense it, it will be shown as offsetting your revenue for this year, but because that's going to make you take a major hit this year, you try to say that it's a capital investment. So you try to book only a little expense this year and in each year for a period of years. You can do that with some assets you purchase, like property, plant, and equipment, but you can't do that with most other expenses. The last example here is that sometimes in financial statements, and because there aren't firm rules about the exact format that they have to follow, you will see categories that are described as net expenditures. Whenever you see the word net, you always need to ask the question, net of what? Ideally, you'd like to see the top line figure with all of the adjustments and then a bottom line net figure. If you see things described as net expenses, you have to wonder what's being buried in there. So for example, net expense could be $5, but if it's actually $300,000 minus $299,995 in expense, that's a big difference than whether it's $5 total or the difference between these two huge numbers. In the latter case, you'd always want to know what the $300,000 and the $299,995 represent and not just pay attention to the $5 net. Anything that doesn't have a breakout is cause for asking the question, why did they not want to break it out? What information might be hiding in there? That leads to the last category, which is entitled Possibly Hiding or Burying Important Information. The first thing to keep in mind is that there are important things that are not reflected in the financial statements at all. It's just a simple lack of transparency, and by the way, it's not necessarily all bad news. There could be good news, and that's what we tried to capture with some of the examples we've listed. We talked before about the value of brand equity. Coca-Cola has huge brand equity, and it's not reflected in the financial statements. You just need to understand that when you're looking at it. Another example is when you buy property, plant, and equipment and it appreciates in value, that fair market value may not be reflected on the balance sheet. Your increasingly valuable PP&E is an asset of the company that you could sell and turn a nice gain, but not necessarily for book purposes unless and until you do actually sell it and realize that gain. Some other examples that flow not so much from your financial statement analysis, but more from your strategic analysis or SWOT analysis, which stands for strengths, weaknesses, opportunities, and threats, are the company advantages that the company may have that can be very significant and that can create barriers to entry for competitors. Those are not reflected anywhere on the financial statements. For example, the company could have intellectual property. They could have a drug that they have just had approved that they will have a patent on that drug. No other company can produce that drug during the exclusive term of the company's patent, which gives the company a monopoly on exploiting it in the market. That could be worth billions of dollars, and yet it's not reflected as an asset on the balance sheet. Those earnings will show up as revenue when the drug is sold, but nothing until then, at least under GAAP. Recall that IFRS allows you to book some R&D in certain circumstances, so the value of the drug may not be reflected in R&D depending on which rules you're following. Two other examples are supply chain efficiencies. Think about how efficient Walmart's supply chain is, but that's not directly shown as an asset on the balance sheet, although it does show up when you look at the efficiency ratios, as we did before, and the company's human capital. Even if you've hired, trained, and retained the best team in the world in a particular function, that won't show up as an asset on the balance sheet. There's no line item for the value of your human capital. You can imagine that there are people and teams who can single-handedly change the fortunes of a company in terms of its likely future performance. Maybe even a single rock star CEO like an Elon Musk or a Steve Jobs back in the day. That's not anywhere on a financial statement. Finally, there are certainly categories of bad news that may not appear on the financial statements. For example, be very careful about reading footnotes that seem unintelligible. These are smart people. They don't write things that are unintelligible unless they know they're unintelligible. And it can gloss over important details. We'll see some examples of that happening shortly. Be skeptical when you're looking at an annual report where the company spends a lot of time talking about their projections and less time talking about their actual past performance. There's a reason they're talking about projections more than past performance usually. Be very careful about huge write-offs. We talked about the big bath, but there's another version of this where people take a write-off on a cost and they claim, well, it's just a one-time cost, and they hope that investors will look the other way. But in fairness, it's a cost that's very likely to be recurring. Also, with regard to companies that have a lot of debt, in general, those companies face more risk because the banks are going to have a series of loan covenants that are attached to that debt. Loan covenants are requirements or restrictions on what the company can and cannot do, and sometimes those can be significant. You're not going to be able to see that from the financial statements, but that could seriously affect the value of the business and the ability of the business to operate, particularly during a recession or other economic shock. The banks may have rights that aren't simply apparent from the fact that it has debt. Of course, most annual reports will have a section on executive compensation describing how it's structured, and presumably they're going to tout how it's aligned with just best practices. But just look for conflicts of interest. You want the company's executive management typically to have a set of incentives that are aligned with the shareholders' incentives. And so you want to look for situations where those incentives may be misaligned. Using the company's earnings to buy back its own stock, which tends to inflate the share price, thus benefiting corporate managers who own shares and, most importantly, who hold options, may not be the best use of that capital for the company, as opposed to the best use of the capital for the company's manager. So that's the one-page summary of potential red flags, and I think that many times you're going to read in the news about a company having a problem in this area, and my guess is it's going to fall into one of the categories, or more than one of these categories. Some of these things are going to require a combination of looking at some of the disclosures that are in the schedules to the financial statements, such as where you would find information about their executive compensation plan or information about the company's debt. In many cases, you may need to put two and two together. Let's assume the company has this big credit facility or these outstanding notes. I know from my experience as, let's say, a secured transactions lawyer, that debt like that is going to come with X, Y, and Z covenants. And one of those covenants is going to be you can't pay a dividend, or one of those covenants is going to be if you have a material litigation judgment against you, that could put you in default. These are sophisticated people and sophisticated companies, and maybe their debt covenants are different from what you've experienced in your practice, but maybe not. The point is that all of these things are going to give you clues that are going to lead you to ask more questions and maybe solicit more expertise and more expert advice about a particular area. But at least this will give you the ability to spot those things, and that will lead you to ask further questions in certain well-known danger areas. Now I'm going to turn to a couple of examples of companies that had what we might call red flags that actually did turn into be something that these companies were either failed or being investigated or charged for a violation of the accounting rules. We talked about one of the red flags being a disparity between the company's profitability and its operating cash flow. So think about that. You look at the net income statement and you go to the line that says net income, which means profit, and they have a nice profit. Then you go and you look at the statement of cash flows, and there are three sections there: cash flow from operations, cash flow from financing, and cash flow from investments. If you have positive profitability, but you have negative operating cash flow, that should be a red flag. It doesn't seem sustainable that you can continue to make profits while you're having negative cash flow from operations. I'll give you one example here with the collapse of the financial services company, Bear Stearns, that precipitated the start of the 2008 financial crisis. That may have come as a surprise to people, but they're actually very important clues that we could have looked at, and one of these had to do with the red flag I just mentioned. If you look at the 2007 financials for Bear Stearns, which we have included in the materials, the company had a negative $2 billion in operating cash flow. And yet, you look at the income statement and you see a nice profit of $233 million. And you say, well, how is that even possible? As I said, the company can generate cash from other sources besides operations, and one of the significant ones is cash flows from investments. In that case, Bear Stearns had significant investments in PP&E, and what they did is that they sold some of those investments. And so when you added the cash generated by selling the PP&E, you end up with cash flow from investments that were more than sufficient to offset the losses from operations. It's a nice example of seeing an unsustainable practice of having negative cash flow from operations and a positive net income. You can only sell your headquarters once, right? And that's essentially what they did. It's also an example of how looking only at a net number, the $233 million, can be misleading versus looking at the $17 billion Bear Stearns generated in cash from investment sales and the $2 billion Bear Stearns lost in cash from operating activities to spot the red flag. Another example that I think is interesting, and sticking for the moment with the 2008 financial crisis, is Lehman Brothers. From 2005 to when Lehman collapsed in 2007, its debt increased by more than 100%, and yet the cash flow from operations was declining each year. So you say, how is that possible? It's clearly not sustainable that you would just keep borrowing more and more money while you're not generating as much money from operations. In the Bear Stearns example, they were making up for the loss of operating cash flow with investment cash flow. Lehman Brothers was making up for the operating cash flow losses through financing activities. What's the financing activity? Borrowing money from the bank. If you look at the debt-to-equity ratio, which is, as you know, a measure of the firm's risk or leverage, it went from 4.42 in 2005 to over 7 in 2007. You also can see the cash flow from operating activities decreasing from negative 12 billion to negative 36 billion to negative 45 billion, while the cash flow from financing activities increased from 12 billion to 38 billion to 48 billion. Anyone looking at these statements would say, I expect a firm of that size to be generating substantially a positive cash flow from its operations. And if that number is hugely negative and they somehow still manage to get to profitability, they must be using one of these other two vehicles, either investing activities, selling the headquarters, or financing activities, meaning borrowing the cash. That's why it's so important to have those two different groups separated out in the statement of cash flows. Another way to create the illusion of profitability is by simply changing your books so that you show income and therefore greater profitability when the company is not actually earning any additional money. We talked about the use of a company's reserves to do that, and here's an example involving Nortel Networks Group. In 2003, Nortel wasn't having a good year, and it had something approaching $200 million in reserves. As I noted, if companies have reserves that are very high and they have net income that is not as high, sometimes they would release, aka put their hand in the cookie jar, some of that reserve. If you have a legitimate reason to reduce the reserve because you won a big case or you realize that a potential liability is actually much lower, you can reduce the reserve in the current period. But there needs to be a triggering event that you can point to say that that's the reason we are reducing the reserve by X amount and choosing to do it now. Needless to say, income smoothing is not the reason why you can release something from a reserve. Nortel Networks was accused of reversing about $80 million in reserves simply to income smooth, and as you might not be surprised to learn, that $80 million made the difference between Nortel having a year that was negative in terms of profitability and it actually becoming profitable. That was obviously a problem because they could not justify it. The company ended up terminating the executives who were involved and had to restate its earnings, which is always one of the company's least favorite things to have to do, and had to explain that this was done in violation of GAAP. These things are at least potentially understandable from the financial statements as we've seen. If you see negative operating cash flow and positive profits like Bear Stearns, that should jump out at you. If you see a company selling its PP&E like Bear Stearns, that should jump out at you. Or if you see a company borrowing increasing amounts of money year after year like Lehman Brothers, Or if you see a company just releasing enough reserves to turn a loss into a profit like Nortel, that's enough at least to ask questions. Now, there are many other examples of types of behavior by companies that are much harder to spot in a financial statement, so you won't necessarily see a red flag. A good example, I think, is Kmart in 2001. At that time, Kmart appeared to be having financial problems, and Kmart eventually did file for bankruptcy in 2002. Obviously, prior to the bankruptcy filing, Kmart was interested in conveying financial strength, and what the company did is it built up a huge amount of inventory, which created the appearance of a large asset on the balance sheet. But what was not clear from the financial statements is that they also were slow paying their vendors, which allowed them to keep more cash on hand. More assets were available to be shown in the snapshot of the assets that they had in the form of the balance sheet. Now, if you slow pay your vendors, at a certain point, they will stop providing goods to you, and that's in fact what happened with Kmart. They had a lot of vendors terminate the relationship, which is a huge problem for the company, but it's not apparent from the balance sheet. One place that might give you clues that something untoward is going on are in the footnotes to the financial statements and the schedules filed with the financial statements. These footnotes can give you clues about the assumptions the company is making. Any lawyer worth his or her salt is going to be focused when people state conclusions on what assumptions were made. The same thing is true with financial statements. There are footnotes dropped all the time that explain how a number was calculated, and they are supposed to identify the key assumptions. But you'll have to parse the fine print in order to find where the bodies are buried. In the Kmart example, you might have found a reference in the footnotes to Kmart shifting to pay vendors on a 90-day terms instead of 45 days, and that would have been a clue as to what Kmart was up to. Another example might be that if a company bought a fleet of corporate vehicles and you decide that the corporate vehicles are going to last you for 5 years, for example, you're facing a tough year, maybe it's the year that you would normally want to replenish some or all of those corporate vehicles. And then suddenly, in a footnote, it says the company has changed its assumption about the useful life of cars from 5 years to 7 years. What they've done is on paper, they've magically changed the financial statements to increase the value of those assets, when in reality, the value of those vehicles remains unchanged. These cars are really supposed to only be valuable for 5 years, but now they would like to carry them for 7 years. So that's the importance of looking at that in the footnotes. One last example, and this is by definition going to be the hardest one to spot because it's literally not on the financial statements. Everyone's familiar with Enron, and much has been written about the problems there, but the fundamental issue was off-balance sheet loans. We just got done talking about how important it is to dive into the balance sheet, looking at the liabilities, looking at the ratios, reading the schedules and the footnotes. Well, nothing could be more destructive of one's ability to think about the financial strength of a company than not seeing those liabilities in the financial statements. And so you always need to keep that in mind. While there have been a lot of regulatory changes to try to limit companies' abilities to do that in the wake of Enron and other similar examples, but I don't believe that it's impossible for companies to continue to do it in certain circumstances. So that's another red flag if a company you see in the news potentially has off-balance sheet liabilities. This brings us to a quick summary of what we've covered today. First, we asked the question, why do financial statement analysis? We learned that financial statement analysis allows us to answer important questions about a company, such as, is this particular company well run or not? Is it profitable? Does it have more or less solvency risk than its peers? How much is it worth? There are lots of things that go into that kind of analysis, but looking at the financial statements and doing the common size and ratio analyses and looking for red flags are important pieces of that puzzle. Then we talked about the key financial statements, the balance sheet, income statement, and statement of cash flows, and how they relate to each other. We talked about some key accounting principles and focused a little bit on revenue recognition because it's very important. Then we talked about financial statement analysis itself in 2 parts, common size and ratio analysis, and how that allows you to compare companies like Walmart and Costco, even though they're very different in terms of size. You can put them in apples to apples terms and then compare both to each other and to other companies in their industry and other industries. Finally, we talked about the importance of conducting a red flag review, which boils down to identifying some categories of things that if you see them on a financial statement or in a schedule or a footnote, should cause you to ask more questions. We showed you some real-life examples of some red flags that if people had seen them in time, they might have helped to prevent the failures like happened at companies like Bear Stearns and Lehman Brothers. I hope you enjoyed today's program. Thanks for watching.